Welcome back to Renewable Rides. Today, we're revisiting one of my favorite conversations with Lee Jackson, co-founder at Bridgeline. He and his partner are helping some of the world's largest commercial real estate owners modernize their portfolios through technology, innovation, and energy transformation. In this highlight episode, we unpack how the very definition of a building and how it creates value is being rewritten. Lee shares how the industry is moving beyond traditional leasing models toward new revenue pathways, from digital infrastructure to onsite energy, that are reshaping how owners think about net operating income and tenant experience. You'll hear how technology and ESG are no longer just boxes to check, but real value drivers for investors, tenants, and communities alike. And we close by exploring how onsite energy is becoming a competitive advantage, and in moments of crisis, a literal lifetime, when grocery stores can become community hubs. It's a conversation that connects the dots between capital markets, technology adoption, and the future of real estate. Let's get after it. What are some of the other nuances that live within both the public markets and then maybe private is a bit more different because it's probably kind of owner specific, but maybe you can comment on some of that.
It is, yeah. I mean, I think the public REITs are in a unique position, and the funds from operation, the FFO, is a big driver of those businesses. And I think that's what makes them some of the best operators in the marketplace. They're very disciplined in how they are running those portfolios from a management perspective. And I think that's a great thing. It's allowed the REIT structure, specifically in North America, to grow to and amass portfolios of 300 plus assets, which is astounding when you think about it. It creates a unique complexity because the playbook has to continue to evolve, but you're playing on so many different fields or regions or geographies that some struggle and some thrive in, creating a structure that allows them to be opportunistic in a market and take advantage of what's offered in those markets. But sometimes it can be paralyzing because you're thinking about it at just like a huge portfolio level and kind of applying a very focused, singular-minded playbook. With respect to the private markets, there's a lot more nimbleness that's available. Those groups can focus on, debt and, deploying capital for long-term visions. They can assemble and think about large master plan communities and development projects. Ultimately, the driver of the majority of these businesses is 95+% is coming from rental income. So lease spread is absolutely one of the key dynamics for every single person in this world. And the debt service coverage ratio is really important too, because you are borrowing capital to capitalize these acquisitions, and then you are servicing that debt over that projected life cycle of the hold. And that's a key component, and it's what's, either forced some transactions, and it's also what's allowed people to continue to sort of borrow against these properties over time, depending on what that is, to opportunistically grow their portfolios. So it's complicated, and there's lots of unique dynamics, and there's lots of risk affiliated with what you choose to do. But fundamentally, it's really about having great management of these assets in place so that you're maintaining the properties and not having major leakage. You're keeping them leased up. And those are sort of the key components.
Yeah. Well, so within that, I don't know how far we'd have to zoom back, but like way back, if you will, like commercial real estate was this, and forgive me for the oversimplification, but it's like you've got your box and you lease out the inside of that box, whether it's retail, office, distribution center, you name it. And that's the primary, to your point, revenue driver is the leasing revenue that's coming from that. How has that evolved with, I've found it fascinating getting introduced to folks that are, they have alternative revenue in their title. And so that's mean
Sure.
They're looking for revenue opportunities, which is going to drive up net operating income that is not tenant leasing. What are some of those pathways that you've seen start to bubble up and evolve over the last couple of years? And then a build on of that is like, what have asset owners had to do in order to attract great tenants, retain great tenants, elevate the value of the leases that they have with their tenants to meet these overall objectives?
Yeah, there's a lot of questions in there, Dan. So, I mean, I'll start with your opening comment. Like, the traditional thought is you set it, you lease it, and you forget it, right? For the next 10 years, 15 years, 20 years, whatever the term is that's in place. The reality is that there are a lot of variable expenses. There are regulations that are impacting the markets. Debt has, changed over the last 5 years, 15 years, and 25 years quite meaningfully. So debt periods and borrow rates don't always line up with the hold period that you initially set. So when you do have to go back and recapitalize and restructure the debt on these assets, that can significantly impact the NOI on the projects. And when you pair that with rising costs, energy costs is a big one, which when you're looking at insurance increases because of lots of different dynamics. But I think climate resilience has driven a lot of that forward, especially in certain markets. If you've set a lease rate for the next 10 years with a tenant, that is really demarginalizing the business. So becoming a better operator has become a huge focus for many of these groups. When you pair in rising construction costs in today's marketplace, we're seeing less construction starts than we've seen in many years. I think the inventory growth and new construction starts, development permits, there's less out in the marketplace being delivered. So it's stabilizing the capital markets because you can't just go and buy land and build because it's a little bit too expensive. You can purchase and grow through acquisition, but you're purchasing prepared product and you're having to apply an operational playbook in addition to leasing. To go to your question around like how do you grow that side of the business, there's a lot of theories out there, but typically, I think the playbook is really focusing in on what the ecosystem and the essence and the vision is for a particular asset. So if you're a grocery anchored center, great. Who is your anchor grocer? Making sure that the merchandising around that sort of fits, and data has been huge. How much traffic is being driven? What's the market size? What are the sales that can be driven from this store? And being able to tell and sell that story and reinforce it with the things that go around that. If you need to market the asset, if you need to apply for the right permits to get the appropriate access to ensure you're funneling more people into a project, these are all key components to the attractiveness to key tenants. And co-tenancy is a big thing. If you can attract best-in-class tenants that are traffic drivers, that are resilient as far as some of the disruptions that have been in the marketplace. Grocery has proven to be probably the strongest in that sector. People like to pick out their groceries. It's a daily need. We eat multiple times a day.
Yeah.
You need it to survive, whether you're going to work, whether you're working from home, or, whether you're spending the weekend with the family. That's something that exists no matter what. So that's been a really good foundational tenant. The other side is placemaking and driving traffic and trial. If you can be the place that people want to live, work, and play, well, then you've got the most important thing that retailers need, especially those that are in the aspirational categories. They are the people, right? If people
Yep.
are spending their time and dwelling, and especially for that pivot and that movement towards, destinations, so restaurants, et cetera, they need the people. They need the constant traffic to be in place. So those are some of the dynamics that we see out in the marketplace today, for sure, taking place.
Yeah, certainly. Well, let's shift into talking specifically about technology. I mean, that's your whole practice is digital solutions. So What are you seeing, and how are these, again, forgive me, but like kind of older school operators and asset owners that have been in the space, how are they adopting technology? What's piquing their interest? What are some of the trends that you're seeing?
So it comes in different formats, and I think some are doing a better job than others. But I'll zoom in on a couple of key things that we're seeing take place. I think the pandemic was a huge driver for this. Retailers are using this, occupiers are using this, whether it's office, industrial, retail, it doesn't matter. But data analytics and business intelligence has really just boomed. Whether it's mobility data that retailers and owners can use to understand exactly what is the trend line as far as what the traffic is that's coming into a particular center, what stores are being preferred, where they're cross shopping and going next, what the sort of customer journey is. Those are all really important components from a retailer perspective and an occupier perspective. What are the most optimal places for me to put my store? So predictive analytics, looking at cannibalization. There is data upon data upon data and providers out there in the marketplace that are really driving that component. And then on the business intelligence side, you already have a surplus of data from your property management solutions, from your existing core as an owner. But how do you tell that story in a unique way? So we're seeing business intelligence, dashboards come in and they're feeding just data lakes of information to kind of pull out these insights, which are giving them insight into, where are the opportunities from a mix. So that co-tenancy, who can they put in place? Where are the leakages, inside of the business operationally, where they're overpaying or they're underinvesting in components and parts of the project. And you get a lot of that from your property management software, which is well distributed. Another place, and I think ESG reporting has driven a lot of this, is smart building technologies. A lot of the data inputs that are required through the SEC and GRESB reporting structures for portfolio companies were very manual for groups to go out and gather at each individual. And if you think of a portfolio, REITs are a great example of this with 300, 400, 500 assets. It's one ESG report for that REIT. Those inputs, though, are each individually reported. So you've got to go out and collect the utility data from each of the sites. So smart building technologies and putting in the right checks and balances around monitoring and real time understanding for the devices that you require for energy management has been a big boom. I think building automation systems for HVAC, lighting, and security is sort of the next tier. Like once you can monitor it and understand it, then you can start to put in adoption and solutions. That's sort of the next tier and the next level of sophistication in the space is, now that we know that no one's in the building on weekends, we can turn the lights off. We can turn or wind down the HVAC systems, and we can make really meaningful contributions to our bottom line on energy. And we can make really meaningful contributions to our goals with respect to, net neutral carbon initiatives, things of that nature. So those are a couple of key ones, Dan, and certainly if you want to zoom in on any of those, we can do that.
No, I think that's a great overview, and I would like to start digging in on some of the energy stuff. You've hit on it a couple times here, and how have you so smart building technologies and building optimization, I think are critical ones. You mentioned ESG and the reporting. The REITs have these requirements to report these, so it's not necessarily something that is always by choice. But I'd also say that the companies that are out there from a sustainability perspective making these bold commitments are typically consumer-facing companies, and retail is obviously a consumer-facing environment. So how has the conversation around energy, whether it be costs, sustainability, or resilience, because I think, again, when we think about grocery, from a resilience perspective, that's particularly interesting in places that maybe have outages. There's some great examples from some of the winter storms that hit Texas back in 2021 and 2022 of grocery stores becoming this community hub where people could come and get water, charge their phones. So it's kind of all three, the cost, sustainability, and resilience side of things.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.